Dr. Matus, explain how we prosper with just an okay economy.
Look, if you want big growth, big inflation, that's what we have now. Does anyone really feel good about it? And the answer is, of course, no. I think as we look ahead, what we need to see is we need to see growth coming down a little bit. Inflation, obviously, it would be better if it came down a little bit. But we also have to bear one thing in mind about inflation. It's not so much the level, it's the volatility that creates problems. So you can have a higher level of inflation over a persistent period of time, and it's not going to be as disruptive as if you have a slightly lower level of inflation that goes up and down by a dramatic amount every period. The earlier one, the former one, is easier to plan. It's less disruptive to hiring and less disruptive to investment.
Well, let's talk more about the hiring. What was your takeaway from the Friday jobs report and what it means for the Fed in November?
My takeaway from it was it wouldn't sway the Fed one direction or the other. If you look at the details and you look at the headlines, the headline payroll number missed, and everyone was upset by that. But if you look at the details were great. If you look at the unemployment rate number dropping, which people theoretically could like, wasn't really great because the participation rate declined as well. So it was one of those cases where the headlines were wrong, but the underlyings, offset them. It was just a mess of a report, and I think what it speaks to is there's a COVID story going on, there's an expansion of government benefit story going on, and then of course there are a lot of delays and shortages in the economy, which I believe are beginning to show through in hiring trends. Right? There's no point in hiring a worker if you're not sure the parts are going to show up at the factory. And so, it kind of, it creates a delay throughout the supply chain where the factory is not going to hire the worker until they get the parts. The people making the parts aren't going to make more parts until they get the order from the factory. And then they're not going to hire people. And it creates this chain effect back through the economy that's really not a positive and represents a real threat to growth.
Let's talk about a positive, and it really is in the eye of the beholder. Drew, explain to our audience why you think higher interest rates can help, why they can be a good thing.
Oh, well, so Jonathan, you hit on my favorite topic. Zero rates at a policy level are incredibly distortive to economic activity. There has to be a price for risk. There has to be a price for, you have to get paid to save. And if you're not being paid to save, creates all kinds of distortions. I'll give you kind of just one great example. People have talked about the low inflation environment we've been in for a long period of time. Well, not if you're trying to retire, right? If you're trying to retire, if you include retirement or some sort of payment into retirement plans as part of the inflationary basket of goods and services that someone is buying, that's become a lot more expensive because the yields have been so low that you can't actually assume that you're going to get a decent return on your money for a long period of time. And so then you have to save more. And so ordinarily people think, oh, interest rates go down, people buy more. Not if you have a large cohort of the population moving towards retirement. When interest rates go down in that environment, they actually have to save more and buy less, and it creates a downdraft on economic activity.
Work with me on this then, Drew. If there's been some intergenerational wealth transfer from the eldest in society on the monetary policy side, can't we say the opposite on the fiscal side over the last several decades? Don't those two things cancel each other out?
I think we're talking about levels of scale. And of course, you can always, as we know, with the fiscal side, kick the can even further down the road. And, when we think about the environment that we're operating in with the United States, we have a lot of people globally who want our securities, right? Who want Treasury securities and are willing to buy them. One other concern I have with a low rate environment, and when you think about negative yields, think about this. Negative yields represent people being extraordinarily aggressive in terms of risk. No one, if they were going to buy a 10-year security of any kind, would actually take a negative coupon unless they were planning on selling it on, right? If you had to hold it to maturity, those things would never price at negative yields because no one's going to take that. And so what's really going on is that people are assuming that they're going to become even more negative yielding. And so they're basically making bets on how things are working. They're not actually buying because they particularly like the security.